Between 2003 and 2023, the S&P 500 returned about 9.8% per year. But the average equity fund investor? They earned just 6.8%. That gap cost them nearly half their wealth over 2 decades. And the number one reason for that gap is something almost every investor tries to do: timing the market. I have been investing for over 50 years. I have watched people try to time tops and bottoms in 1987, in 2000, in 2008, and in 2020. And the data is overwhelmingly clear: they almost always make it worse. Today I am going to show you exactly why market timing fails, what the actual numbers look like when you miss just a handful of the best days, and what the smartest investors in history do instead. This might be the most important investing lesson you ever hear. This is the single most devastating piece of evidence against market timing, and it comes from J.P. Morgan's annual Guide to the Markets report. Imagine you invested $10,000 in the S&P 500 at the start of 2003 and simply held it for 20 years through the end of 2022. Your $10,000 would have grown to roughly $64,800. Not bad. But if you were out of the market and missed just the 10 best trading days during that entire 20-year stretch, your return drops to about $29,700. You lost more than half your gains by missing 10 days out of roughly 5,000 trading days. Missed the best 20 days? You are down to around 17,800. Missed the best 30? About 11,500. You barely beat inflation. Here is the part that makes this especially cruel for market timers. The best days in the market tend to cluster right next to the worst days. 7 of the 10 best days in that 20-year period occurred within 2 weeks of the 10 worst days. So the very moment you panic and sell, you are almost guaranteed to miss the snapback. Let me give you some real examples of what market timing looks like in practice. March 2020. COVID hits. The S&P 500 falls 34% in just 23 trading days, bottoming at 2,237 on March 23. Panic was everywhere. The American Association of Individual Investors Sentiment Survey showed bearish sentiment hit over 50%. Investors pulled a record $326 billion from equity mutual funds and ETFs in March and April of 2020. What happened next? The market recovered all its losses by August. It finished the year at 3,756, up over 16% for the full year. Those who sold near the bottom and waited for things to feel safe missed one of the fastest recoveries in market history. The same story played out in 2008 and 2009. The S&P 500 fell 57% from its October 2007 peak to its March 2009 low of 676. Investors fled. But from that March 2009 bottom, the market gained over 68% in the following 12 months alone. Peter Lynch, the legendary Fidelity fund manager who averaged 29% annual returns over 13 years, said it best: far more money has been lost by investors preparing for corrections, or trying to anticipate corrections, than has been lost in corrections themselves. Every year, a research firm called Dalbar publishes a study called the Quantitative Analysis of Investor Behavior. And every year, the conclusion is the same. Over the 30 years ending in 2022, the S&P 500 returned an average of about 9.65% per year. The average equity fund investor earned about 6.81% per year. That difference of roughly 3% per year might sound small. It is not. $100,000 compounded at 9.65% for 30 years grows to roughly $1.5 million. That same $100,000 at 6.81% grows to about $720,000. The average investor gave up nearly half their wealth, not because they picked bad funds, but because they bought high when markets felt exciting and sold low when markets felt terrifying. This is what behavioral economists call the behavior gap. It is the difference between what an investment earns and what the investor in that investment earns. And it is caused almost entirely by emotional timing decisions. Buying after a rally because you feel confident. Selling after a drop because you feel scared. It is human nature, and it is extraordinarily expensive. So if timing does not work, what does? The answer is boring. And that is exactly why it works. Dollar cost averaging. You invest a fixed amount on a regular schedule regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this naturally lowers your average cost per share without requiring you to predict anything. Warren Buffett himself has said repeatedly that for most people, a low-cost S&P 500 index fund purchased regularly over time will outperform the vast majority of professional money managers. He made a famous $1 million bet in 2007 with hedge fund manager Ted Seeds that the S&P 500 index would beat a basket of hedge funds over 10 years. Buffett won easily. The index returned about 125% over the decade. The hedge funds averaged roughly 36%. Time in the market beats timing the market. That is not a cliché. It is a mathematical fact supported by decades of data. Here is the principle I want you to take away from today. The market rewards patience, not prediction. Nobody, not fund managers, not economists, not television pundits, can consistently predict short-term market moves. The data proves this over and over. What you can control is your behavior. Invest consistently, keep costs low, stay diversified, and do not let fear or greed pull you off course. The investors who build real wealth are not the ones who guess right. They are the ones who stay in the game. If this video helped you think differently about your investing approach, hit subscribe. We put out a new video every single day breaking down the principles that actually build long-term wealth. And I want to hear from you in the comments. Have you ever tried to time the market? What happened? Be honest, because we have all been there. Tomorrow, we are going to look at one of the most powerful forces in all of investing, compound interest, and why Einstein may have called it the eighth wonder of the world. I will see you then.